over to Jennifer Inman to kick us off.
Okay, I feel like we're old friends. I've been here so often. I hope that my policy meetings get shifted so we're not on a Monday and I'll actually be able to join the club. A lot of familiar faces, and I'm making friends as I get to know all of you. So not only do I get to share with you about financial literacy education, but through you, we're sharing financial literacy education throughout the state of Kentucky. So I am honored today that I have Sheila Bair in the room, and because of you, we're giving away, specifically because of Rotary, 100 of her books to students today. We're actually giving hundreds of books away due to generous donations. But we've already been to one elementary school this morning. We have 2 more and a family math night later today. We'll also be speaking with the women in business at NKU. So we have a full day, and I don't want to delay your ability to hear all of the great things that Sheila has to say. So I'm going to turn it over to Sheila Bair.
So thank you, Jen. It's so nice to be here. You know, I grew up in a small town in southeast Kansas, and my dad was a Rotarian. And I have the really fond memories that Rotary would sponsor a little train that would go through everybody's neighborhoods, and you'd come out and donate a toy, and you get to ride on the train. That was the highlight of my Christmas every year. Later, I was telling the group here, I ran for Congress actually in my home district in 1990, and went to a lot of Rotary meetings. And then as president of the college in Chestertown, Maryland, I was also active with the Rotary there. So thank you for all that you do. I can tell, you know, Rotary's been around for so long, all the philanthropic activities, the community contributions you make, especially around the holidays, really you make, I know, created very fond memories for me, and you're still doing it every year with the community that you serve. You may know I'm the former chair of the Federal Deposit Insurance Corporation. Most people know me from that. I'm old. I've done a lot of stuff. But most people remember me as chair of the FDIC during the great financial crisis, where we obviously had a very serious financial crisis and a lot of bank failures. A lot of people still ask me about the safety of the banking system. You probably saw that we had a couple of very large, regional bank failures last spring. And I tell people that not to worry. First of all, if you're below the insured deposit caps of $250,000, there's nothing to worry about bank failures. We may have a few more, but I think overall the banking system is sound. And those banks that failed last spring were really kind of textbook examples of mismanagement. I have to think they're outliers. It was very rapid growth. They loaded up on a lot of very low yielding long-term securities trying to get yield, which if there are any bankers in the room, that's a really stupid thing to do when interest rates go up, right? So, and amazingly, this is Silicon Valley Bank was the one that most people were paying attention to. They had this huge uninsured deposit base. So uninsured deposits they can run because they're not protected by FDIC insurance. And so they had these billions and billions of uninsured deposits that were held by venture capitalists, Silicon Valley venture capitalists, Mark Cuban. I mean, some of the richest people in the world had uninsured deposits. And when they woke up and realized this bank had been mismanaged, they pulled it all out of the bank quickly. And that caused me to joke that maybe venture capitalists need some financial education, because if you pull all your money out of a bank, you force the bank to fail. You know, it's not, hello, did you read It's a Wonderful Life, that famous scene with Jimmy Stewart, right, when there's a run on the bank during the Depression, and he's explaining, no, those deposits have been lent out to help people buy homes. But apparently, I think venture capitalists do need a little financial education about how banks work. Anyway, that underscores a larger point is why, I've been a bank regulator most of my life, a financial regulator most of my life. I've been in the securities oversight, derivatives, banking. I've seen it all mostly in bank oversight. And financial education really does have benefits from a financial system stability standpoint. If you look at what happened during the great financial crisis, when all of those terrible mortgages were made to people that couldn't afford them, they didn't understand them, they had very steep payment shocks. The terrible tragedy about the subprime, what's been called the subprime crisis, was most of those mortgages were not getting people into homes, expanding home ownership. They were refinancing people out of nice, safe 30-year fixed rate mortgages that FHA had been into these, what they call private label mortgages that, again, had very steep payment shocks, and they were designed to force people to keep refinancing every couple of years because the payments would go up, and they couldn't, the way they were underwritten, they were quite unaffordable. And so if the payment went up just a little bit, and these payments went up a lot, you'd have to actually refinance to get the payment back down to the starter rate. So folks signed these mortgages, you know, people would come, they were push marketed, they'd come to folks' doors, the targeting of minority neighborhoods was terrible. They'd knock on the door and say, you know, hey, you know, they would research in advance if somebody had equity in their home. They'd say, you want to take this equity out, we'll give you some cash, you know, go on vacation, repair your roof, whatever. I mean, they would go door to door, that's how it started, and then it got completely out of control. But folks just understanding basics around mortgage finance and loan affordability and debt obligations, and just, you know, reading a contract, understanding a contract, just those kinds of basic skills. That's not to excuse any of the abusive behavior that was going on. It was terrible. And now we have a Consumer Financial Protection Bureau that has set mortgage standards, so most of that, thank goodness, has gone. But if people had been better equipped to protect themselves, we would not have had the problem that we had. So I do care about this passionately. As one who's been most of my life in bank regulation, I've just seen too many instances where people either are ripped off through scams, or more frequently, these are legitimate products, but they're misused, right? So overdraft protection is a prime example. As originally started by banks as a courtesy, if you overdraw your account, you know, they'll cover it, and you don't go through the embarrassment of a bounced check. But it just got to be too easy, and at $30, $35 a pop, and again, you would see lower income folks, households that live paycheck to paycheck, making heavy use of overdraft protection. I mean, these studies were showing thousands, if they were spending thousands of dollars a year, because they just kept chronically. And those banks, even if they started with good intentions, weren't doing those people any favor. Credit cards, another example, you know, oh my gosh, everybody, pay off your credit card each month, please, because, you know, especially now with interest rates significantly higher on credit cards, you carry those balances month after month. You just make that minimum payment. You are paying a lot in interest. And if you can't make a payment, then you've got the late charges on top of that. And then there's interest on top of all of that you're paying for. So I just see so much, you know, heartache with families that don't have a lot of money to begin with, losing money because they don't understand financial basics. And that's not to say that financial education can substitute for good consumer protection regulation. I think you need both. But regulators can't be everywhere, and they can't micromanage the system, and you just got to make sure that we empower people as best as we can to protect themselves. So I believe strongly too that you start early. So I've been writing kids books for elementary school students, ages 7 to 10. Actually, my first book came out in 2006. I think you have some of the tables might have it. It's called Rock and the Savings Shock. That was the very first book, and it's about compounding interest and how compounding interest will make your savings grow to significant amounts. If you leave your savings there, you don't spend it. It's about a grandfather who offers a savings plan to his twin grandsons, Rock and Rock. He offers to pay him $1 a week for doing chores, and if they save the $1, he's going to double every dollar that they save. But if they spend it, they don't get any doubling; they just get another $1. So I use doubling to illustrate the power of compounding, just because obviously you're not going to be able to find a bank account that's going to be paying you 100% interest every week. But it gives the example of how the power of exponential growth. And later, a more recent book is called Billy the Borrowing Blue-Footed Booby, which is the reverse about how compounding interest will hurt you if you don't repay your debt, because then that interest just keeps piling on, and the debt load just grows exponentially. And Warren Buffett has famously said that if you're going to understand finance, money, you've got to understand compounding. It really is just core and basic to be understanding the wealth benefits of saving and leaving your money, savings in a place where it will get compound growth, and the extreme danger of borrowing more than you can afford to pay back and letting that debt grow and those interest charges grow, and how that will strip your wealth. So those are two of the books. There are 8 total. One's about equity finance, Isabel's car wash, I think that may be also on some of the books, some of the tables. My two most recent ones are a little different. One is called Money Wizards. It's about inflation because that's a little different for me. That's more economics than personal finance. But you know, family, we're all struggling with inflation. It's going down. Thank goodness the rate is going down. But still, you know, prices are so much higher than they were a few years ago. So it still bites. And just the basics around, you know, putting a lot of money into a system that is supply constrained, right? So you give people a lot more money, and we did that with the best of intentions during the pandemic, give people more money to spend and help them financially, but if there are supply constraints, so the things available to buy with all that extra money is kind of staying the same, prices go up. And that's illustrated in this story, Money Wizards. And I think, you know, it's just basics, economic basics that some people are skeptical. Oh, an elementary age child will not get that, but they do get it. I do a lot of school readings, I talk to kids, and they get it. They absolutely get the basics, and they're interested in it. And I think we want to get to them at an early age, because this is just, you know, and the one thing I love about picture books is that parents read them with their children, so I get so much mail and feedback from parents and teachers too, that they learned something as well when they read the book with the child. And there's back matter in each of the stories that kind of break down educational material that breaks down the economics around what's going on in the story. And so it's a way of providing some stealth education to parents as well, in a way that they don't have to be embarrassed that there's, you know, maybe they don't understand compounding and they learn it by reading one of my books. So I found it tremendously gratifying. The other most recent book is called Daisy Bubble, and that's about speculation. And you know, this was inspired by a lot of the nonsense that was going on in crypto. I don't know if you remember the 2022 Super Bowl, all the crypto ads, remember those? Or football fans here? I mean, who is the target for that population? Maybe teenage boys. I mean, teenage boys tend to not have as good of impulse control at that age. Their emotional maturity lacks somewhat. They're risk takers. They want to, you know, they're seduced by the glamour of making it big, making a lot of money fast. They're vulnerable, susceptible, and you know, and a lot of them did. And meme stock craze is another thing. And you look at the demographics of who invests in crypto, who invests in meme stock bubbles. It's 18 to 24-year-old boys. So the Daisy Bubble's about the risk of speculation. It's kind of a riff on the tulip bubble of, you know, in the early 1500s. Speculation's been around a long time, so there was this tulip mania in the Netherlands in the early 1500s, where, you know, tulips got to some god-awful sky-high price, and then of course the market collapsed. This is about daisy bubbles, Floriana daisies, going wild on the Galapagos Islands. But it's a fun book, but it's humorous. I don't like to be didactic. I don't wag my finger and do this and don't do that. I try to have fun, you know, stories that kids can chuckle at and laugh at and learn by seeing how silly the characters are, and that they should not repeat those behaviors. So it's been a good passion for me, and I really appreciate Jen and, you know, everybody here who's been in Kentucky, who's helped arrange all the different events I'm doing today. We're doing some more school readings this afternoon. Yeah, I just love talking to young people. They do get it, and it's important to, I think, early on to teach them, try to instill a healthy culture around money, right? Just help them understand there's so much marketing, there's so much consumerism, you know, so much buy, and they start thinking of money just in terms of things, right? And they don't make the connection between how hard it is to earn money and how important it is to protect and manage that money well, because it is hard to earn. And so anyway, let me stop there. I would be happy to answer any questions you have about the books, about the financial system, about me. You know, I tell the joke when I was the chair of the FDIC. It was 2006 to 2011, and we had this terrible crisis, and we were stabilizing the large banks and stabilizing the wholesale funding markets, and we had about 400 failures. And so Forbes magazine named me the second most powerful woman in the world 2 years in a row, right behind Angela Merkel, which was shocking to me, still a shock to me. But anyway, I guess it was more of a statement about the importance of the FDIC back then. But later, when things calmed down finally, my last year at the FDIC, I went to speak to my daughter's elementary school about banking. I've always loved to engage children about banking and financial basics. And the principal mentioned this to me, and mentioned this in his introduction of me, and so when I delivered my remarks, and then I asked the little girls if they had questions, the little hand went back up in the room, she said, well, who was number one? It was kind of hard to impress them, I guess, number two wasn't good enough. Anyway, I was there for 2 years in a row, then in 2010, I think I dropped to the 14th ranking. I was behind Lady Gaga, which I was just devastated about. And then the last year when I left the FDIC, I dropped off the list, but I was at the top of the list of people, of the important people who dropped out. So anyway, it was, some people say we have a good crisis. I don't know if anybody had a good crisis, but I'm very proud of the agency and what we did to stabilize the system. Perfect record. Not only did we protect all insured deposits, but we ensured seamless, access, because people don't care if their money's in a checking account. The money may be safe, but it's going to take 2 weeks to access it. That doesn't really help. So it was a very high priority for me that we had a corporate goal actually every year. You had to have any depositor in a field bank had to have access to deposits within 1 business day, and we always hit that, and I'm very proud of that. So anyway, let me stop. I really would be happy to hear what's on your mind. Any questions I can answer about banking, anything else, financial literacy. Yeah.
So my daughter has several kids, okay? And so we were talking the other day, my wife and myself, about how they go about buying things. So when they buy things, they put their hand out to mom, and mom puts money in their hands, and then they go get what they want.
Yeah.
Whereas when I was a kid, I had to either cut grass, do things to make, my weekly allowance, and things of that sort, where they don't have to do all that.
Yeah.
And so they're not gonna be much in the way of saving, but, all they're getting is just things.
It's free, right?
Yeah.
Well, a lot of kids think money's just free, and I got a question at school this morning, can you give us some money? Well, but if you buy my books or donating, if you read my books and take those lessons to heart and live by them through your adult life, you will make a lot of money, right? Because I'm gonna keep you from losing money. I'm with you, I'm old fashioned. I think parents ask me, but they just have different views. Allowances should be tied to chores, because that shows the connection between working and earning money at an early age. And if it's just, I know there's some people say, well, you should give them a bit. I've always thought that it should be tied to chores. I do think that helps them at an early age understand that money is something that's hard to get, because that incentivizes them to take good care of it too. And on savings, we had a take out 10 rule, so every dollar our child got, whether it was the allowance or, money from grandma for birthday or whatever, 10% went into a clear piggy bank. And then as the money accumulated, so they could see the money grow in the clear piggy bank, and then when it got full, we took it to the bank and put it in a real bank account. And actually, once they got started, they would usually save a lot more than 10%, because they liked it. Their rewards there's a sense of self-satisfaction for controlling your impulses, saving some of the money, watching it grow. It's a good feeling, but I think, again, exposing kids to that kind of behavior, again, the culture around money, how they think about money, I think is really important. Yeah.
I just want to share a little secret here
Sure.
about how us baby boomers are totally screwing up these Gen Zers. I'm like Gary, I enjoy the NKU dinner theater.
Right.
I decided I no longer have to buy tickets. And so you can go into a yogurt store and the bill's $8.52. So I intentionally give them $10, wait till they key it in, oh, I've got 52 cents. And the reaction could be, oh my, what do I do now? After 3 teenagers, they finally realized that I got $2. So just pass that on to the kids that we're intentionally messing with their heads.
Computers and calculators, they don't have to do
They
it
can't-
anymore. They
well,
don't know how to do it anymore. That's the scary thing. Yeah.
Well, and here's my concern. I do a lot of small business, simple stuff, setting up 401k plans. The kids today, 18, 19, know nothing about money, markets, what's a mutual fund, they just don't know anything about it. So, I mean, I'd love to see you guys, you've got to start emphasizing back in school, we need to get these basic math skills
Yeah.
back in school.
Yeah, no, I agree. Yeah, Regent McGuire here.
Yes.
Did you have a question? Thank you.
Yeah, I had a question. What is the national average now as far as savings percentage? I know it's been going
slow.
down and
Yeah,
down and down. and
Yeah,
down.
it went up during the pandemic because people had a lot of extra cash. It's going down. Credit card delinquencies.
And don't you think most of it, I mean, like we're talking about education-wise or lack of, but the advertising, the marketing that's out there, and it's so easy.
It is.
Get into that, I can buy this, I can have that,
Yeah,
but guess what? I'm gonna be set back so far.
It is.
And,
they just,
I don't know how you really change that now with that, it's been generations living that way.
it is so hard. It's really a tidal wave. And one of the things, a recent financial innovation is this buy now, pay later, BNPL. And that is just, here again, like a lot of financial products, if you use it exactly right, according to instructions, you're gonna be fine. But those who provide those products and services make money by you misusing it. So, right, if you say you've got, okay, great, I'm gonna do BNPL, I can spread this payment over 4 months with no interest, right? Or that's usually where every 2 weeks, that's usually how they're structured. But the problem is, the reason they can provide that zero interest loan or very low interest loan is because the retailer, the company that's selling whatever it is paying them because this incentivizes impulse buying. So people buy things they wouldn't otherwise buy. They probably couldn't afford it. They had to pay cash for it right then. They couldn't afford it and they wouldn't buy it. But then psychologically, oh, well, I can spread this out over 4 payments. I'll figure it out later. They don't figure it out later, so there's an auto deduct from their checking account. They get hit with an overdraft fee. Or they realize they can't afford it, so then have to pay it off with their credit card, and they're running a credit card balance. So people get trapped with this, but the core, the threshold problem is, it's just what you say, it's designed to get people to buy on impulse, even if they can't afford it. Usually they can if they feel like they need to spread out the payments. Yeah.
What was your career path that got you to be the chairman of FDIC?
Yeah. Well, I'm a lawyer by training, and I started my career, I'm old, I started my career back in 1979. Well, I taught law for a year, and then I joined the General Counsel's Office of the old Department of Health, Education, and Welfare, and the old Department of Education. And actually, I did a lot of civil rights work back then. That was, there was a title, something called Section 504, discrimination, disability discrimination, federally funded programs, and Title VI and Title IX. Parallel laws for race and gender discrimination. So I did a lot of that type of work. And then I'm a Kansas Republican, and my senator, Bob Dole, asked me to come work for him on the Senate Judiciary Committee because this was with the Reagan Revolution and Republicans had just been trying to take control of the Senate. He was going to be the chair of the court subcommittee of the Senate Judiciary Committee. There were a lot of big civil rights issues, including the Voting Rights Act coming up. So he needed a civil rights lawyer, which it was perfect timing for me. And so I broadened my portfolio there. And then I worked for him for many years, and then I was his research director on his 88 presidential campaign. I'm getting to how I got into finance. And if you recall, in 1987, there was this huge stock market crash, right? And that became a big issue. And I had to very quickly, it became a presidential issue, I had to very quickly learn about equity markets and stock market and what was going on, derivatives. It was a very quick learn, but I met a lot of people in financial services through that. And then after, unfortunately he did not win, but the New York Stock Exchange actually then offered me a job, and I worked there for several years. So that was my first foray into finance. But, I think, and I enjoyed that. I think, people in government should benefit from private sector experience. I was with the stock exchange probably 7 or 8 years, and it was good experience. But I've typically liked to migrate back to government public policy jobs because I think, now it's issues of equity. I think a financial system should work for everybody. It should provide opportunities. It shouldn't guarantee results, but it should provide opportunities. And there's still getting back to the subprime mortgage crisis where vulnerable people, in lower income neighborhoods who actually accumulated equity in their homes, they were being targeted, they were being trolled by these unscrupulous mortgage lenders to pull that equity out of their house, give them an unaffordable mortgage. And I just, being in government regulation, you have more direct ways and tools to try to protect people on that. But I still, I'm involved with a couple of, in my current portfolio, I'm on a couple of corporate boards. I do a lot of advisory work, and then I'm a senior advisor to a couple of nonprofits that support financial stability, regulation, and oversight. So I enjoy it, but that was basically my career path, the stock exchange, and then I ran for Congress in 1990 and almost won, but didn't quite. So then H.W. Bush offered an appointment to the Commodity Futures Trading Commission. That was my first government regulatory job, and I was the commissioner and the acting chair there for a while. And then doing various and sundry things. Then he asked me, then his son, George W. Bush, asked me to come back into government and be the Assistant Secretary for Financial Institutions at Treasury. So that is the arm of Treasury that does financial banking policy, basically. And then W. Bush asked me again to chair the FDIC. I joke that I should stay out of government because, throughout my life, and a lot of women, and dads too, will sympathize with the eternal juggling of family responsibilities and kids versus demanding careers. So I kept kind of segueing into these really high demanding government jobs and academia and other places where I could have a better work-life balance. But I kept being seduced back in. And, when I went to Treasury in 2001, 9 months later we had 9/11. And then we had the Enron failure. And so what had been kind of a 9-to-5 job became a 24/7 job. And I did that for about a year and a half and got, rebuilt our financial infrastructure as part of that, because the 9/11 attacks were absolutely an attack on the financial structure, the financial infrastructure of the United States. So then I went to academia for 4 years in UMass because I had small children and I didn't have any time for them. So, but then George W. Bush asked me to come back to be chair of the FDIC, and then we have the financial crisis. So I do think I should stay out of government. Something like that. Every time I go in, I said they should not want me anymore. Good question. Anything else? Yeah.
So one of the outcomes of the pandemic seemed to be a switch to a cashless approach to things, and so you've got a great just curious what your predictions are for cashless central bank, as you get the
central bank digital currency,
that sort of thing.
Yeah.
Is that something that's on the doorstep?
I think probably less so. So in Asia, particularly in China, they won't take cash anymore. It is completely cashless. And I think that's probably because in China, they don't have any concept of personal privacy. They just resign themselves. The government's going to know everything about them, right? So they don't really care that everything's electronic and be tracked, because that's just, they may care, but it's just they accept it as a way of life. In the U.S., I think there's more sense of personal privacy protections, and I think some people, even if it's legitimate reasons, sometimes people want to make transactions that there's, that are private. So I think there will always be a demand for cash. And of course, there's middle office stuff too that goes along with cash, so which is the problem. Our central bank, the Fed, has not shown an eagerness to do a central bank digital currency. Other countries obviously are moving ahead. There's a lot of political pushback against the U.S. because there are a lot of private stablecoin issuers. So these are private entities that issue stablecoins. You can trade on a blockchain, but they're fully reserved by fiat currency that's typically put in a bank account or short-term treasuries. So they're liquid, risk-free assets that back it. So those, I think, you might see those get more traction and those as a substitute for cash. But I think because the private sector has these stable coins, Republicans at least are really pushing back against the Fed doing its own because they feel that would compete with or interfere with the private sector initiatives that are going on. So yeah, I don't think we'll have a central bank digital currency anytime soon. We don't. But these stable coins might become more popular. Okay, great. Thank you.
Actually, Sheila, we're gonna ask you to do us a favor. We have a raffle today. So we're gonna have you draw the raffle ticket.
Oh, good.
A little bit of gambling.
Yeah,
thank you very much.
Thank you. All right. Get one here. Okay, it is ticket 104. Oh.
Close.
Better check mine. No, I'm 111.
104,
$25
Mary.
There we go.
Thank you.
Great, thank you so much. Actually, I did update this slide. So next week is, I believe, is it Christian Dallas? Who is a local mural artist, and you probably have seen a lot of his work around town. He's actually gonna be able to make it, so, and then the following week is, can't think of her name, it's a senator that John Nicole has arranged for us, so that will be another good one, so. That is it, I hope everybody has a great week, don't forget Christmas conference tonight, we've got the events at Stevens, so lots to do, so, thank you everyone.